Okay, let's unpack this. We are diving headfirst into the software infrastructure sector.
A key battleground for sure.
Absolutely. This is where the digital plumbing for the global enterprise and the whole AI boom is being built.
Yep.
So our mission today is a sharp journalistic deep dive into 3 stocks that really highlight the incredible diversity and, well, the volatility of this space. Palantir, that's PLTR, CoreWeave, CRWV, and MongoDB, or MDB.
That's right. And for you, the listener, we're synthesizing a ton of data points into a critical analysis. We're going to look at these companies based on, their valuation, their financial stability,
The technicals.
the technical performance, and the news that's really driving their recent price action. We want to show you exactly where the market is placing its bets and where the risk lies.
And to make this all a bit more tangible, we'll cap each segment with a fun hypothetical test. We're taking $5,000 in paper money
Just paper money.
and calculating the estimated profit or loss you would have seen based on the most recent monthly performance for each stock. It's just a vivid way to see the impact of short-term swings.
And before we jump in, just a quick but really critical clarification. The figures we're discussing here are purely for informational and educational purposes.
Yeah.
They reflect the source material we analyzed, and they are absolutely not investment advice.
Absolutely. Okay, let's start with the immediate, unambiguous winner from our recent data screen, MongoDB, ticker MDB.
The database platform company.
Exactly. They run massive tools like Enterprise Advanced and Atlas. Market cap is around $33 billion.
$32.7 billion, yeah. But that's not the number that jumped off the page.
No, it's the price action as of the December 2nd close. A staggering positive 22.23% in a single day.
I mean, a 22% jump in one day. That's not just regular trading. That's the market completely re-rating a company overnight.
So what drove it?
Well, what's fascinating here is that it was entirely driven by concrete fundamentals. This wasn't just hype. They reported what news outlets immediately started calling a monster quarter.
Monster quarter!
Yeah, a huge Q3 earnings beat. And this is the critical part. They raised their full-year guidance.
Right.
This is management delivering way beyond what anyone expected.
And the analysts reacted instantly, right?
Oh, immediately. We saw a wave of buy ratings reiterated, and price targets just shot up. Monness, Crespi, and Hardt, for example, they raised their target to 475.
475. I saw BMO Capital Markets move theirs to 455.
Exactly. So the consensus target is now sitting high at, what, 428.64? It's a big shift.
But here's the part that always gets me with these growth stocks. Despite all this momentum, all this analyst love, MDB is still technically unprofitable.
That's the contradiction, isn't it? The earnings per share, trailing 12 months, it's negative 0.88. Profit margin is negative 3%.
So the market is paying a premium, a huge premium, for growth that's still just anticipated. That forward PE is already high at 73.76.
It is.
So wait, the market's paying a PE of 73 for a company that's losing money. Doesn't that make MDB just as vulnerable as some of the riskier bets if that growth, that 21% projection, falters?
That's a great question, and normally, yes. But this is where the balance sheet becomes the safety net. MDB's financial health is, frankly, exceptional.
Okay, so how exceptional?
Look at their liquidity. The quick ratio is 5.46. Current ratio is 5.03. Now, put that in plain English, MDB has over 5 times the short-term assets it needs to cover all of its short-term liabilities.
Wow, 5 times.
Plus, debt is virtually non-existent. The debt to equity is just 0.01. That kind of fundamental strength allows investors to tolerate the current unprofitability. They believe the growth story is secure.
And that stability fueled the technicals. That massive single-day spike put MDB almost 4.5% above its previous 52-week high.
And it's been a beast all year. 107% gain over the last 6 months. The relative volume was also super high at 5.11, which confirms this was a high-conviction buying spree.
But there has to be a warning sign here, right? With that much momentum.
There is. The Relative Strength Index, the RSI, is at 71.38.
So it's in overbought territory.
Firmly in overbought territory. The buy trigger was clearly that Q3 earnings report, no question. But once the RSI crosses 70, momentum traders might be getting ready to take profits.
Right.
So a sell trigger could be on the horizon if the price fails to hold above that previous 52-week high. You could see a sharp pullback from here.
Okay, let's run our visualization. Say we hypothetically invested $5,000 in MDB at the start of the month.
Based on its monthly performance, which was an 11.72% gain.
Right. So at that closing price of $401.99, that $5,000 would have bought you about 12.44 shares.
And given that 11.72% monthly gain, the estimated profit on that $5,000 paper investment would be $586.
So the total value would be $5,586, a very solid return.
It proves the power of investing behind strong, fundamentally driven momentum.
Okay, so MDB shows us the power of a healthy balance sheet, but let's shift gears completely. Let's look at a company that is profitable, highly efficient, but where the valuation is, frankly, terrifying.
You must be talking about Palantir.
Palantir, ticker PLTR. The massive AI government giant, the heavyweight of our analysis with a market cap of over $400 billion.
$406.8 billion, yeah. And it presents one of the biggest puzzles in tech right now.
How so?
Well, on one hand, their fundamentals look great. They're genuinely profitable. EPS is 0.43. Profit margin is a robust 28%.
And their efficiency it's off the charts. Gross margin of 80%, very low debt.
Exactly. But, and this is a huge but, the market is demanding this massive, massive premium for their software platforms, Gotham and Foundry.
The government defense moat.
That's the narrative.
Yeah.
And the valuation multiples are just astronomical. We're talking about a price-to-earnings ratio of 399.
Almost 400. So you're paying nearly $400 for every $1 of annual earnings.
It's incredible. And the price to sales is over 100. Even when you factor in their high anticipated growth, the PEG ratio is over 8.
And just to remind everyone, a PEG ratio over 1 is usually seen as a sign of overvaluation.
8.07. It strongly flags that the stock is massively overvalued relative to its future growth. The market is either supremely confident or it's trading on pure story.
Which brings up a critical question. If the valuation is this insane, why are insiders selling now? Shouldn't they be holding on?
It's a great point, because despite the huge yearly gains up 158% year over year, the stock just had a really steep monthly decline.
It dropped almost 15%.
Negative 14.86%. And that drop lines up perfectly with the heavy insider selling we found. CEO Alexander Karp, Shyam Sankar, Stephen Cohen.
All selling.
Massive, sustained selling all through November. Millions of dollars in shares were dumped. That kind of pressure for the people closest to the company, that feeds investor caution.
And technically, the stock is showing that weakness. It's trading below its short-term moving averages, the SMA 20 and SMA 50.
Suggests a bearish trend for now. The RSI is pretty neutral, around 47, so it isn't oversold or anything. But it's almost 18% off its 52-week high.
So what's the trigger here?
A cautious buy trigger could be if the price rebounds off these recent lows. But a potential sell trigger is if it fails to break back above those moving averages. That would suggest the downward pressure is continuing.
All right, let's run the numbers for KLTR. If we invested that $5,000 at the start of the month, based on that negative 14.86% loss.
At a close price of $170.69, that would get you about 29.29 shares.
So that negative 14.86% performance means the estimated loss would be $743.
Right. Your total investment value would now be down to $4,257. A sharp reminder that even a great story doesn't protect you from short-term corrections.
Okay. We've seen the secure growth of MDB and the profitable but hyper-premium PLTR. Now let's go to the extreme end of the risk spectrum. CRWV, ticker CRWV.
The pure play AI infrastructure bet.
Exactly. Focused on sophisticated cloud computing. Market cap is $37-38 billion. Closed recently around $76.
CRWV is the ultimate example of that high-growth, high-burn model that's dominating the AI discussion.
It's deeply unprofitable. EPS is negative 1.82. Profit margin is negative 19%.
But sales growth is huge. Quarter over quarter, 133%. And future EPS growth is projected to be an explosive 83%. The market is valuing its potential.
But that hypergrowth, it's happening on a financial foundation that looks like quicksand. The company is highly indebted.
Very. The debt-to-equity ratio is 4.85. Their debt is nearly 5 times their equity.
And that's not the only problem.
No, it's compounded by a severe liquidity issue. The quick and current ratios are both extremely low, at 0.49.
In simple terms, that means CRWV doesn't have enough short-term assets to easily cover its current bills.
It's a fragile financial structure trying to pull off explosive growth.
And this vulnerability is all over the news flow, right? Talk of an AI bubble, massive debt piles.
Exactly. and famed short sellers are actively flagging these risks. This negative sentiment has led to, well, catastrophic recent performance.
Catastrophic is the right word. While it's up 90% year to date, the performance last month was a staggering negative 43.14%.
A 43% drop. In 1 month. This isn't a correction, this is a market reckoning.
And the price is now trading nearly 60% below its 52-week high.
And it's almost 28% below its 200-day moving average, which is that key long-term trend indicator.
So it's completely broken down technically.
Absolutely. The RSI is very low at 33, so it is approaching oversold territory. You see people like Cathie Wood talking about buying the dip. But the sell trigger was emphatically hit when it crashed below those long-term averages. A buy trigger here is purely speculative.
And the insider activity
Reinforces the whole bearish narrative. A massive negative insider transaction rate of negative 18.41%. We saw large proposed sales from officers and trusts, including co-founder Brennan McBee.
So for every dollar bought by insiders, nearly 20 cents were sold off. That is a massive signal.
It is. So let's do the impact test for CRWV. $5,000 invested at the start of the month, based on that brutal 43.14% loss.
At a closing price of $76.03, you've gotten about 66 shares.
The estimated loss on that $5,000 paper investment would be a devastating $2,157.
Wow.
Your original investment would now be valued at just $2,843. It really shows the high-risk, high-volatility nature of these kinds of plays.
So this deep dive has shown us 3 wildly different journeys in just one sector.
Absolutely. We saw MongoDB surging on real earnings strength, backed by an amazing balance sheet.
Then Palantir, profitable and high quality, but facing what looks like extreme valuation fatigue and heavy insider selling.
And finally, CRWV, demonstrating immense volatility, explosive growth, but resting on a very fragile, high-debt structure.
And what this really tells you, the listener, is that this software infrastructure label covers a huge range of companies. While MDB shows strong fundamentals can provide buoyancy, those massive growth narratives often come with intense risk.
Ultimately, the market is demanding that profitability, or at least extreme financial health, has to eventually back up even the most compelling AI stories. The big question is, whose narrative is going to be sustainable when the hype finally fades?
And here's a final thought. Considering CRWV's catastrophic 43% monthly drop, what impact will that highly negative insider selling, that nearly 18.5% net selling, have on investor sentiment if this AI debt and liquidity narrative continues to dominate the headlines? That's something for you to track until our next deep dive.